Hi guys, today we will discuss intraday level, that is 4 hourly level. Now I have just turned it 4 hourly, right? And it's the same AK steel, so we will trade intraday to see how it works. Now let's look at it. So the last candle is a red candle eating all these candles, so it's a bad signal. The next day it opens lower, so we will not be buying it. It's not bullish. And if you look at it, it's just falling off. We are not doing anything special. It's just falling off. Now, right here, this is what I call the confusing part. Now, this is what I call something that rises up, but usually I don't buy that because I believe that's a dead cat bounce. A dead cat bounce means it has fallen so much that usually the short sellers buy it and it rises somewhat to a position, but it's not a money making machine at that moment. So you should not be buying it. Now, although this looks like a rising piercing line, but you would have made money by buying it at 422 and selling it at 439, but I am not that much happy, to tell you the truth. Basically, it's not something great, and if you look at it, it did fall off. Now, why am I not really bullish? Because there is a reason for that. Usually, market makes two lows on the fall. So this was the first low. It would be making a second low, and you should also note that if you see something falling off a great length, example right here, this high is $6.28, and from this high it went low till $4.25. So that's a $2 fall. That's what, 50% fall. After 50% fall, don't expect the market to just rise up and make a V signal. Even if it does make a V signal, I won't be that much bullish, because basically in trading you have to cover all your bases, and this kind of a V trading is usually a trap, and I won't request you or suggest you to trade that. So wait for it. Now this fall helps you understand that okay, the second low is being made. So from now onward, if we find a bullish signal, we will trade that. Right here. Let me zoom in more. Now this green candle has 18. So basically this green candle makes us buy again. This is our lifeline candle. The green candle that eats everything up. The bullish engraving candle. Just look at it further. It goes up, up, and then falls off. Now this candle tells us get out. Why? Because this red candle is again eating this candle. Not a good sign. Now you might ask that this is a loss making trade. Yes, it is. You closed at $4.16 and you bought it at $4.23. So that's an 8-cent loss. Yes, it is. But then this is what trading is. Sometimes you make money, sometimes you lose money. The question is that you should not be losing money on bad trades. You should be losing money on good trades. It's like if someone is throwing you an excellent ball in baseball and you get out on strike 3, then it's not your bad batting. It's basically his good bowling. So basically you need to see this as good trades from the market. You'll be trading every time as per your goals. Now your goal is to trade on a bullish candles. If you're buying, you need everything to be bullish, not bearish. So if you buy it on a bullish candle and it traps you by letting you know to get out on this day, then you will get out. And you will always be looking at the trades each and every day. You won't be offline. If you want to trade on the long run, trade weekly. But if you want to trade daily, then you will be looking at the market every day. And every day before the closing, you need to be at your seat checking it out. You cannot just ignore the trade, because if you will lose money. So you should be vigilant of what the market is doing. Now, our second trade, right here we bought it. Now, one thing I forgot to tell you, this is the 4-hourly chart. But this is the most recent trades. If you look at it, this is November 2017. This is what I call just recent trades. Just look at it. The next trade rises up, 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 down, up. So if you look at it, we bought here at 422. Now it is 460. That is what? 40-cent profit. Huge. Exceptional. That means 10% profit. Right here, what we lost? 23, and this is 16, 8 cents. That's negligible profit or loss. But here, it's 40-cent profit. Huge. Right here, I believe it's a 2% loss. Right here, it's a 10% profit. But the trade is not completed yet. Ooh, it went up. It opened higher. $4.87, closed $4.85. Now, this is what I call the opening closing gap. Now, let me zoom out to show you one more thing. Whenever the market will be bullish, it will always open higher. See? And whenever it will be bearish, it will always open lower. Now, by opening lower, I don't mean this smaller opening higher stuff. I mean a major gap. This kind of a gap. This was bullish, so it opened higher. A huge gap. And this gap usually is something that it tries to fill up. And it did fill up right here. This is the gap left. So once we started trading here, we know that we can expect the price to rise at least $5.85. At least. So this is what I call the target making. This is what I call a good trade to be on. If you would have bought it on the lows, right here somewhere or right here somewhere, you would know that you can easily expect the price to rise here. Easily $5.85. That's what I call the easy game. And that's why I'm showing it here. If you see some kind of a fall with a gap, then remember, the market will come back to test it. Now, not initially it didn't test it, but we are not trading, we are not buying it initially. We would have bought it right here. Right here. So, once we bought it, we know that the market will come back up. And if you look at it, it's still bullish. Still bullish. Right here, this is the red candle. It went lower. And it's like our sell mark. But we have forgotten one thing. The thing that we discussed right here, that the price from the lows will touch the high of 585, also applies here. It opened with a gap up. So we believe that it will come back to touch it. Now if I just zoom in, it opened higher, then made two green candles, then made a small red candle, then again a higher open, higher close candle, again a red candle. So we knew that it will eventually come back to fill this gap, and this red candle filled the gap. The next day it opened a green candle, red candle, green candle. This green candle is an engulfing bull candle. It ate this red candle, and this, eating this red candle, means a bullish run. So you will be buying it again. Now if you remember, initially we bought it here at 422, sold it here at 466. That's 40-cent profit, 10% profit. Now we have bought it again at $4.79. So now my basic presumption or trading game plan is always be in the bullish wrap. Don't fall into the bearish trap. Please remember this. Now you are seeing that I am using the bullish candle more than other patterns. Now why am I doing that? Because I believe that after all the pattern, the most profitable pattern is the bullish pattern. Now, if you look at it, no other pattern is so much available or so much popular on the chart than bullish pattern. And that's why they're the most used or sought after pattern. Bullish or bearish patterns. Example right here, it was the bearish engulfing candle. And this made the most of the trade. That's what I teach you. This is a dark cloud cover. And it opened higher. So basically this dark cloud cover was nullified once it opened higher. So always remember this. You see a pattern, don't agree with it until the next day is open. Because if it opens with somewhat a bad example right here, it opened higher, so it nullified this pattern. And that's an important thing. So open close is really important. If it is opening with a gap higher, then remember, there's something wrong. And the previous pattern, whichever you are seeing, is nullified. Now let's look at it further from this trade. It opened higher, higher, and then two red candles. Now this is important. You look at it, it's breaking the lows, but on the close basis, it has not eaten this green candle. Now you might ask, this is what I call dark cloud cover or something of a morning star stuff, but it's not. Reason being, in a morning star, you need a good medium-sized candles. These are not medium-sized candles. Just look at the breadth of this candle. $4.85, $4.89. 4 cents only. That's not a medium-sized candle. So don't fall into the trap of picking the patterns yourself. Look at the chart and ask yourself, does this look like a pattern? If not, then rely on the bullish or bearish engulfing candles. They're the most helpful candles. Boom! Again, a good green candle. Opened at $4.89. Closed at $4.99. Awesome. No problems at all. Then this is the dark cloud cover. What I was talking about. So this is $4.89. This is $4.99 close. This is $4.99 open and $4.89 close. So this red candle has eaten this green candle. The body of this green candle. And once it does that, what do? We sell. We get out. We don't trade it. The next day, it opened higher. Once it opened higher, we would have bought it again. Reason? The previous candlestick pattern is nullified. So whenever it opens higher, get back in. Reason? Because it's nullified. Now you might ask, then we should be waiting for the open. Basically, this is the question where I myself is not sure. I haven't reached a conclusion myself. So I'm not telling you the answer as well because I don't know the answer. Now if you wait for the next day's open, usually it could open even further lower. So you lose money. And my game plan says never lose money. Always get out at a certain point. Yes, it would have opened higher and you would have lost all this money from this open of $4.89, from this close of $4.89 till this open of $5.08. All this money is lost. Totally agreed. But there is a slight change. And that change tells you that go for the least riskable trades. And the least riskable trade means once it made this pattern, you got out. Once it opened higher, you knew this pattern was nullified, so you would have bought back in. That's not a bad trade. The next trade opens lower, lower. Once it goes lower, then it's again telling you there is something wrong. This close is even below the open of this green candle. Now once I told you this pattern was nullified, I'm not saying that ignore these two candles. Consider it not a pattern, But once it formed 3 red candles, that's not a good mark. So remember to be vigilant for the next day. And it opened like closes even further lower. Get out. I know it's a lost trade, but this is something part of the game. You get out right here. We bought it at $5.05 and sold it at $4.82, so it's a 5% loss. Then it again opened higher. We will be buying it again. Now you might be asking me, why the hell are we trading it round and round? But that's what the trading is. Candlestick trading is all about making the trade again. Now, my point is, that's why I tell all my students to trade on the longer run. Because on the longer run, you won't be seeing this kind of stuff. On the weekly chart, you won't be seeing this kind of a haphazard way. But as you go further down, 1 hourly chart, 2 hourly chart, right here it's 4 hourly chart, you'll be seeing this again and again and again. You'll be making far more trades. You'll be giving your broker far more money than at any other level. Because that's how brokers make money. Why do you think this is opening higher and closing lower on an intraday basis? It's the brokers. They make sure this happens so that people trade more. That's how they make money. That's a manipulation technique that I've learned by sitting on the floor. I've seen on the floor trading that 2 or 3 brokers will form a monopoly and they will make this happen. Just so that you guys make more trades and the broker wins on both those levels. First, by opening higher, he will sell, and second, by you getting confused and you sell. So it's like double money for them. Now we have bought it and boom, it's going higher. But if you look at it, there is a gap left right here. Boom, higher. So that's what I'm trying to tell you. It's bullish, bullish, bullish. This is again a doji, a long-legged candle, right? But it's on the fall, so it's favorable to your side. Boom. And this is what I call engulfing bearish candle, which has eaten these 2 green candles. We will sell. Now, this is an important thing for you as well. Once we saw this candle, we would have been bullish that it will be rising up. But once it made this candle, this nullified it. So always remember, things do get nullified. It bought it again, so we could have bought it again as well. So my point of view is trade on the longer run. You won't be making these mistakes and it will be easier trade for you. Because once you will be trading on the intraday level, you'll be trading far more trades. You'll be giving far more commissions. Now right here we would have bought it again. So how many trades? 1 trade, 2 trade, 3, 4, 5 and now 6th trade. But wait a minute. This is November 10th. This is December 16th, December 18th. So 40 days and 6 trades. So many trades. And you will be getting a lossable trades as well because brokers will be trapping you. Because I always tell my students that manipulation can be done on the least level, on the smallest level. I cannot manipulate the long-term level. No one can manipulate the long-term level. A person trading on the weekly or monthly, quarterly or yearly scale will not face this much thing. On the yearly scale, he will not face anything. But on the intraday scale, he will face all kinds of manipulation. Example, let me show you one thing. These were 3 falls, right? Now this 4th fall, I believe, was a manipulation technique. Through a naked eye, I can see this as a manipulation technique because usually in a fall, it's 3 falls and it stops there. So you might ask, then why did we sell right here? Because we are following a plan and we don't go outside the plan. Even though we know this is a trap, but we do fall into the trap because we don't break our plan. That's another important learning.